Welcome back. In this video, we will use moving average indicators to enhance our mean reversion trading strategy on the volatility indices. Moving averages are a key tool for spotting mean reversion opportunities. As a lagging indicator, a moving average shows the average of past closing prices over a set period of time. The longer the time frame chosen, the smoother the moving average line will be, making it less sensitive to short-term price fluctuations and better at highlighting long-term trends. There are two common types of moving averages. The first are simple moving averages, commonly called SMAs. They calculate the average price over a set number of periods by adding up the closing prices and dividing them by the number of periods, providing a smooth representation of price trends. The second is exponential moving averages, commonly called EMAs. These averages place more weight on recent prices, reacting faster to price changes and reflecting current market conditions more promptly. In fast-moving markets like the volatility indices, EMAs can be more volatile than SMAs due to their sensitivity to recent price changes. The choice between EMAs and SMAs depend on your trading style and preferences. In this course, we will focus on using SMAs, but you are encouraged to test out both moving averages on a demo account and use the type that best suits your trading strategy. Now, let's delve into the trading strategy itself. Understanding crossovers is essential when developing your moving average trading strategy. A crossover occurs when a shorter-term moving average crosses above or below a longer-term moving average. Think of the short-term moving average as a snapshot of the market's immediate activity, reflecting the most recent price movements and trends. On the other hand, the long-term moving average represents a broader perspective, smoothing out the daily price fluctuations to reveal the overarching trend over a more extended period. In this strategy, traders use crossovers as signals aiming to capitalize on short-term deviations away from the long-term mean. There are two types of crossovers when the short-term moving average crosses above the long-term moving average. This indicates that recent prices have been rising more rapidly than the long-term trend. This crossover suggests a potential short-term uptrend that deviates from the longer-term average. Traders often enter long positions when this crossover occurs, aiming to benefit from the upward move. They typically set the take profit based on expectations of how far the deviation will extend before the market reverts back to the long-term trend. This could be when the short-term moving average approaches the long-term moving average again. Conversely, when the short-term moving average crosses below the long-term moving average, it indicates a potential short-term downtrend. Traders often enter short positions when this crossover happens, aiming to capitalize on the anticipated decline. They set profit targets based on the expected extent of the downward movement before the market reverts to the long-term average. Profit-taking generally occurs when the short-term moving average approaches the long-term moving average from below. Let's look at an example of applying a 5 and 20-day simple moving average crossover strategy to the Volatility 50 index. In this strategy, buy signals are generated when the short-term 5-day moving average crosses above the long-term 20-day moving average. And sell signals are generated when the 5-day moving average crosses below the 20-day moving average. Later in the course, we will explore how to put this strategy into action. Moving average strategies in volatility indices trading can be both effective and challenging. While they offer valuable insights, they are also prone to whipsaws and false signals, especially during quick price reversals. These reversals can cause the moving averages to cross more frequently, potentially leading to multiple trades in quick succession. This increased activity can result in higher spread costs and potentially unprofitable trades. Moving averages can guide your trading decisions, but they don't provide guarantees. This is why it is essential to test your strategy on the demo account first. In the following video, we will explore how to use Bollinger Bands to trade the volatility indices.